India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Trump, do solemnly swear
that I will faithfully execute
the
office of President of the United States.
the office of President of the United States. From this moment on, America's decline is over. First, I will declare a national emergency at our southern border. I will direct all members of my cabinet to marshal the vast powers at their disposal to defeat what was record inflation and rapidly bring down costs and prices. Today, I will also declare a national energy emergency. We will drill, baby, drill. We will revoke the electric vehicle mandate, saving our auto industry and keeping my sacred pledge to our great American auto workers.
Congratulations, Mr. President.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Well, Trump 2.0 is underway. Those visuals, those pictures, essentially President-elect Trump becoming President Trump, taking the oath, and of course, lots of executive orders have come through. There is a fair bit to unpack here and more over the next couple of days and weeks. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, hi, good morning.
Hi, good morning, folks. So watching that speech, I was just like, he was not smiling yesterday.
Yeah.
There was no banter. It was all very, very serious. I think he was on a mission to tell the world that he's going to deliver exactly what he promised.
Yeah.
And we had a lot of those announcements starting to come through yesterday immediately.
Well, Trump, he looked like, in his earlier day, he was the advisor to Mike Tyson. Mike Tyson should finish that boxing game in the first round. But gradually he started, easing out. So it appeared he's not going for that one shot, but we're going to see a lot of action in the next 12 rounds or so.
Absolutely. And I think, let's take it from the top then, right? Because it's all going to be Trump and what he has done, what he's said, what he is going to say, what he can say, etc., etc., etc. I just want to quickly put up GIFT Nifty to begin. Usually I look at the GIFT Nifty at the end, but just quickly look at where we are at. And then sort of move from there. It's absolutely flat. We've already seen some volatility. I think we were seeing a gap up, and now it's kind of absolutely flattened out. There you go. Now, so President Trump's second term is underway. He took oath as the 47th president of the U.S. last night. And of course, you saw those visuals, etc. The inauguration speech, and the graphics will come up, focused on key campaign promises and largely on expected lines. So first priorities immediately after that speech, around the same time, when he was taking that oath, the White House put out Trump's first priorities. A border is absolutely the first priority. But for us, from a market standpoint, trade was a big one, right? Tariffs were a big one. He was vague on trade and inflation, at least last evening when he made that inauguration speech. He said that he will overhaul trade systems, but there were no specifics on tariffs, which actually came through. And that is the reason why, the markets perhaps are a little relieved. I mean, the dollar, for example, was anyway during, it's starting at about 7 o'clock or so, there was that Wall Street Journal article which said that he'd stopped short of actually imposing tariffs on day one. And the dollar index was down 1. And that actually deepened a little bit. So no specifics on tariffs, at least not after in the inaugural speech. Just this quote will come up on your screen. So it's not as if he didn't say anything. He said, instead of taxing our citizens to enrich other countries, we will tariff and tax foreign countries to enrich our citizens. Right? So, it means tariffs very much on his mind, and what shape and form, scale, scope, etc. I think the specifics is essentially what we're missing. But later, while he was signing those executive orders, and we'll play a soundbite to this regard, He essentially, in response to a question, said this: "We are thinking in terms of 25% tariffs towards Mexico and Canada. I think we'll do it on February 1st. So again, this is not altogether but disjointed, but he did say that, at least in terms of the 25% which he's spoken about with regards to Mexico and Canada. Dollar index was sharply lower, but I think it's bounced off a little bit from the lows. We're at about 108.43. Remember, we were at 109.30 or so, so we've come off quite a bit from those levels. But most of the move has happened after that Wall Street Journal article, and from that point on, we've not seen any sell-off really. I mean, if anything, we've come up a little bit, as you can see up on your screen. So we put out those 4 scenarios yesterday, and I was saying that the second and the third perhaps are the most likely scenarios. It looks like it's going to be second, which is gradual tariff increases, a moderate approach to tariffs, etc., etc. And a point we'd made earlier as well, peak Trump on the day of the inauguration, maybe the market, unwinds some of these fears and, the dollar goes down, etc. But that's not to say that he's not going to do what he said he will do. It may be more gradual. That's basically about it. The only thing is that if we don't see very much in terms of specifics in the next 1 week, I think we could see a more substantial dollar pullback, which is then going to be positive for emerging markets. So, it's 1 day and then, of course, 1 week or so. But I think the inside of the next week or so, we need to see specifics for dollar strength, yield strength, etc. so to sustain. Now, the other thing, of course, was oil prices. They also came off. Trump said that U.S. will, in his own sort of language, drill, baby, drill. They're going to sort of produce more oil, more gas, and they're going to export it around the world. There was also Russian President Putin, who emerged saying that he's willing to start a dialogue with the U.S. on the Ukraine crisis. Remember, Trump said that he'll end wars and he won't get into new wars. And I think this has been a big expectation, really. So these are largely 2 areas which markets are concerned about. One is tariffs, not very clear at this stage. The other is oil prices. And with regards to oil prices, I mean, I think it's very clear he wants the price of energy to be down. Okay, let's just circle back and tie in the levels here. Yesterday for the markets, we ended about 1% away for the Nifty and the Bank Nifty from their respective 20-day moving averages. We crossed the hourly averages. So the Nifty needs to cross 23,460, which is about 100 points away from where we left off yesterday. That is the first level. And then you're looking at a reach of the 20-day moving average, which stands at 23,578. It's all about 1% or so from where we closed yesterday. I mean, the lows of last week remain essentially the supports which we should not break. The Nifty Bank resistance comes in at between 49,885 to 49,939. And the 20-day then comes in at the 50,069 level for the Nifty Bank. So these are some levels. It's still not very clear how this is going to pan out. But I think it's all about the spectrum. Markets were very nervous that at least a portion of the market was nervous that he's going to go big on day one and impose universal tariffs, etc. That has not happened. So in that sense, I think this is unambiguously positive for risk assets. It's unambiguously negative for the dollar index. But since we are in the moment right now, I think this may take some time to pan out, unless and until, today evening, when I'm assuming he's asleep now after a full day of activities, he comes up with something new. So I think that's where we are at. But tentative kind of start is what the GIFT Nifty is indicating, 20 points higher. Surabhi.
Prashant, I just say that I think anyone who's going to extrapolate anything into any model could be running the risk of losing, millions of dollars in trade, because I don't see the Trump trade being a straight line anymore. From November up until now, it was a nice, clean sweep. It was build America again, make America great again. So it was easier to trade the Trump move. I don't think that straight line exists anymore. And today, if you see market reactions around the world, it's kind of indicating that when the speech was going on, U.S. futures were higher, then they turned flat. Now there's a bit of, upwards bid again because the dollar is cooled off. But, whether the dollar stays that way or not itself is a question. But I think the cleanest takeaway that we have after the speech yesterday, the clearest indication is that oil is going down. Why? Because of 2 reasons. Drill, baby, drill, obviously, and the fact that there is already this executive order in place which is bringing forward a national emergency. And the second, that in general, the world is preparing for hopefully, a more conflict resolution and fewer wars and winding up of the existing wars, which should be, of course, taking off that geopolitical risk premium of oil prices. So that's one very clear takeaway that I had. The rest of it, well, you're muddling along. On tariffs, now he's saying 25% tariffs from the 1st of February on Mexico and on Canada. On China, he's not said anything, but who's to stop him from saying something a couple of hours later? There's already a threat that if China doesn't get a deal ready to sell off TikTok, then there could be tariffs on China. And he's been maintaining this 10 to 60% in terms of tariffs for many, many months. So let's see which way this goes. Let's see how the negotiations go. Speaking of negotiations, the wider ramifications, obviously, we all knew this in the run-up, watching the campaign, but as and when the executive orders come in, it becomes a reality. The US, for instance, pulling off from the Paris Climate Accord. That's also happened immediately, just hours after the inauguration speech got done. So those are some of the things that we're looking at. The Bitcoin markets were on the edge yesterday, while everyone knows that, Mr. Trump is very pro-cryptocurrency. There was no mention of it yesterday in the speech. So again, that took some money off the table. The Bitcoin, which was, I think, about at 109,000, moved to just a little below 102,000 yesterday. So there was a bit of a cool-off coming in over there. So short point is that trading anything straight line for multiple days might become a problem for traders till all of this settles, maybe a couple of weeks down the line. For us, the biggest takeaway, coming back to what this means for us, for me, as I said, the clearest takeaway is the fall in oil prices. And that seems to be a very clear sentiment positive, because we're now looking at Brent around 80. But even here, remember, there's a lot of conversation already and a lot of literature that's been written about this. The sanctions that were announced by the previous administration against Russia and Russian oil companies from which we are buying crude, how will that play out? This is really up in the air. But largely speaking, directionally, oil looks like, there's no move up. Coming back to our picture here, the market has been in a trading range. But the good news is that the bulls have managed to move to the upper end of the trading range at 23,350. Asian markets are mixed. They're a little all over the place, but there is more green than red, short point, across our neighborhood. And let's see if the Nifty bulls can build on that, given that we are at the top end of that trading range of about 23,350 yesterday. On the institutional flows picture, there's not much positive to report. Again, we had a big sell number, selling of about 4,336 crores yesterday. It was offset by domestic buying. So this hasn't stopped. No matter what Trump is doing, no matter what the dollar is doing, this is a constant, at least for now. Let's see when this changes. We have some interesting results in focus and some good ones at that. Dixon was a steady set of numbers. Oberoi Realty has done well, along with other real estate companies. There's MCX, which is kind of in the mix. It's muddling along, some good, some bad. We'll talk about these numbers as we go forward. And of course, we have to watch out for any follow-through reactions on Zomato. That was a big newsmaker at the end of trade yesterday. Today's results tally includes, again, some interesting names. There's ICICI Prudential, Cyient DLM, there's Dalmia Bharat, KEI Industries, there's PNB Housing, Tata Tech. So plenty of mid-caps to keep us busy. Not too many large-cap names, but very interesting mid-caps that we'll be reporting today, and the result reactions that we will track today as well. But for the time being, at least this one event, Nightfall, is out of the way. We've got the 47th US president. Now we pick it up and see, how he walks the talk from here.
Well, that's right. And the biggest positive overnight, as you all mentioned, is the dollar index cooling off. And that's going to be very, very important. So we'll have to see whether the FIs who have been net short, they hold on to those short positions, or in fact, they see a bit of a short covering bounce, which will be very, very good for our markets. The other factor that I'll be looking at is the cash market selling. They could continue to remain sellers, but with the cool-off that we're seeing in the dollar index, will this number come down a little bit? That's going to be important. So both those two data points is what I'm looking at. What did they do yesterday? No surprises. They added more shorts than longs, and now it's taken their short positions to extreme levels. That's what we have seen on June 4, 2024. And from there, the markets did bounce up. And I've been making this point for the last few days. Declined net long positions, well, it's almost at those levels. And the FI net short positions as well, almost at those levels. And, with the shorts in the system, actually, it's cushioning things, because you always have that in case things are not as bad as it appears so. And the markets have already corrected. The Nifty has corrected 10% from the top. Maybe there is a very high probability that we see a bit of a short covering bounce. Moving to the options data, then two strikes are very, very important. The 23,200 put, the bulls are putting in a bit of a fight, from around the 22,800 appears just in the near term. That's with the expiry around the corner. That maybe, in fact, they'll want to push that base up a little bit. On the upside, the 23,400, 23,500 odd level is going to be a bit of a resistance zone. So just to plug in the numbers, the important mark you're looking at for the Nifty, the 20 DMA, that's at around the 23,579. You'll require it to go about the 23,450, 23,500, and then make its way to around the 20 DMA. While the support comes in at around the 23,100 odd mark, going by the options data. The Nifty Bank as well, yesterday it bounced back in style, but it needs to rally close to around 1.5% from here to hit its 20 DMA, which is going to be the important mark On the downside, the recent low, that serves at a bit of a reference point. There are two stocks that I'm looking at for today's trading session. The sector of the day could probably be the metal index. Yesterday as well, we saw a rally. You have the dollar index that's cooled off. That's always music to the ears because base metal prices, they get a bit of a fillip from there. And Vedanta, because of his exposure to metals and because there's a special situation, I'll keep an eye out on that one. The other one I'm going to look at is Zomato. Yesterday, the last tick was around 230 rupees or thereabouts. It ended at around this 200 DMA. So very, very crucial factor. The shots have got piled into the system. It appears the longer-term story is intact, but in the near term, there are some headwinds. So we'll have to see if the stock starts off in the red, whether it bounces from there on, because yesterday the number of shots that got accumulated in the system were very, very large. And, the average price was actually closer to around 240 rupees. The last tick was around 230 rupees. We'll keep an eye out on Zomato. Don't rule out it bouncing from the lows of the day.
Thanks very much, Nigel, for that. Keep an eye out on those names. Well, let's just play out some sound bites, right, of President Trump on those tariffs and a bit about TikTok as well. Listen in.
In terms of 25% on Mexico and Canada because they're allowing vast numbers of people. Canada's a very bad abuser also. Vast numbers of people to come in and fentanyl to come in.
When do you think you would enact those?
I think February 1st.
1st of February. Ed Yardeni is with us, President at Yardeni Research. James Knightley is Chief International Economist at ING. Gentlemen, great to have both of you here. Thank you for your time. Ed, how should markets sort of read what we've heard from President Trump on tariffs so far? Are we to make out that he's going to be pragmatic and it's going to be gradual in terms of tariffs and more of a negotiation rather than sort of putting it out there? Or
I think
you think it still could be the former? Go on.
Yeah, no, I think you're right. I think he's going to be pragmatic. He's going to be a negotiator. It's not going to be anything that startles or there's no shock and awe in his inauguration speech. He certainly talked about every issue that he's talked about before. So from that point of view, there's no real surprises. I think the market should just move on to the fundamentals that matter, and that's earnings. We're in a earnings season right now for the fourth quarter of 2024. We're actually raising our number. The market, the analysts are looking for a 9% increase on a year-over-year basis for fourth quarter earnings. We're looking now for 12%. We were thinking 10%, but the bank news was very, very strong. And so we think that earnings are going to carry the day here. That's what's going to drive the market higher from here on, not valuations, but earnings. And the companies that deliver better than expected earnings will be the ones that outperform. And there'll be a lot in the S&P 500, and there'll be a few in the mid-cap and small-cap area.
You think, Ed, there is, I mean, if it is going to be gradual on tariffs, sorry, just to stick with Trump for a bit longer, you think if it is that way, it's going to pan out that way, there is meaningful downside for the dollar, the broader dollar index?
I don't think so, because I think the Fed is on pause. I don't think they're going to be easing. I think one of the reasons the market did better last week is because Fed Governor Christopher Waller started talking about inflation being pretty close to where they want it to be, and that there might be several more rate cuts. But that just doesn't make sense to me. I think the economy is going to continue to be strong. I think inflation is going to remain sticky above 2%. So I think the Fed's done. If the Fed's done, then I think the dollar remains strong. And I think what we're continuing to see is a tremendous amount of inflows into our capital markets, into our stock market, and into our bond market. Bond yields are very attractive here relative to what's available overseas. So maybe you get a little better return in the UK, but you get more risk. So all in all, I think the dollar remains solid.
Okay. Got that, Mr. Yardeni. Let's bring in James Knightley as well from ING. James, hi. Do you broadly concur with that view? I mean, where do you see the dollar stabilizing? Of course, yesterday was a big pullback, relief reaction because there's no immediate tariff move. But what do you see ahead for both the US 10-year as well as the dollar?
Yeah, I certainly see the dollar remaining very strong, to be honest. We're seeing, again, a reaction this evening, US time, in terms of those comments, those headlines surrounding 25% tariffs on Mexico and Canada, leading to a bit of concern that that could yet see tariffs ratcheted higher as we progress through the year. There's still a lot of geopolitical uncertainty as well. And of course, you've got a situation whereby the Fed is not in a hurry to cut rates any further, whereas the ECB, the Bank of England, other central banks around the world very much are in rates cutting mode. We've got a situation whereby you've got no real political leadership in Europe right now. We've got German elections coming up in February. French elections aren't happening until the summer. So if you want any support from growth, it's going to have to come from the central banks. And that's that narrative, I think, again, points to more rate cuts coming through from there. And that should, again, help keep the dollar relatively supported.
All right, James, what are you factoring in now? But in terms of Fed rate action, I think the last time we chatted, you were hinting at 2 to 3. But going by the recent commentary and data points, are you trimming down that?
I think, like a lot of banks, we're still going for 2 to 3 rate cuts. I think still 3 rate cuts is our view, but certainly it's going to be later. We have been, for the last 6 months of last year, looking for a March rate cut. We're going to be pushing that probably back to June. So nothing really for the next 6 months or so. And indeed, we've got a Fed meeting next week, and it's likely to be one where the Fed is telling us, again, that they're in no hurry. The growth backdrop's pretty good, and Donald Trump's likely to cut taxes, light tax regulation as well, keep the growth story supportive. And in an environment where we're probably going to see more immigration controls, could be at the margin a little bit inflationary. Tariffs, again, could lift prices a little bit more. I think the Fed will be, again, signaling little inclination to cut rates quickly. But we are still nervous about ongoing rises in US Treasury yields, fiscal sustainability in a relatively high inflation environment.
Okay, all right, got that, James. Ed, coming across to you. The last time we were chatting, we were, talking about maybe because the kind of gains that a lot of investors in the US market are sitting on, we may not rule back some kind of a pullback. But earnings, as you said, have been fairly good, at least the start to the earnings. And it appears the US economy as well is on a firm footing. In this sort of a backdrop, will you now rule out that possibility of maybe a 10, 15% cut in the equity markets in the United States? And now, in fact, maybe we could be ending the year with some gains?
Well, I think a week ago we did have a pullback on stronger than expected economic indicators. And so the market sort of dialed back how many rate cuts the Fed would deliver. And then last week we had softer than expected, cooler than expected inflation numbers. We also had better than expected bank data. And so the market was very strong. So right now, I think you can chalk it up to volatility. I don't know that we're making a definite trend to the upside to a breakout. But I do think that the market is likely to move higher over the rest of the year. Still using 7,000 as the S&P 500 by the end of the year. I think it could be none and done for the Fed because the more we get into the year, the closer we're going to get to rate cuts. To tax cuts, and then I can't see the Fed stimulating the economy when fiscal policy is doing that.
Just, James, very quickly, come in on this. Take your point, Mr. Yardeni. I mean, you're still thinking that the bulls will have their way on Wall Street. James, I know you're not into sort of managing money or don't call the markets, but generally the way you see all of this tying in together, do you see risk assets like U.S. equities continuing to appreciate, or is there anything on the horizon that makes you think that at some point there is going to be a pullback because the market perhaps is not reading entirely into the full macro signals?
I think in the near term, the risk environment is going to remain pretty positive. As Ed was saying, I think the earnings story for the fourth quarter should be very good, and that should carry momentum through the early part of the year. And again, light tax regulation, lower taxes, again, should be relatively supportive for that. Still a lot of uncertainty about how tariffs get implemented, but my concern is if the Treasury yields do keep marching higher. We've got mortgage rates up above 7%. We've got consumer credit charges up at 25-plus year highs. If those do keep pushing higher in an environment of slightly higher inflation risks, some concerns about it, fiscal sustainability stories, that could be where there is a little bit of vulnerability, I would suggest.
All right. We'll leave it there for now. James, great conversation. Thank you very much. Ed, it's always a pleasure having you here on CNBC-TV18. We'll sort of lean on both of you over the coming days to decipher if we are to hear more on tariffs or otherwise on other topics from President Trump. Well, we'll take a quick commercial break here at this point. We're going to come back with stock-specific action that you need to watch out for. The special top 10 segment. We're looking at names like Dixon, SBI Cards, Oberoi Realty, Suntec Realty, Paytm and Sugar stocks. On the back of positive news flow, and Zomato, L&T Finance, MCX, J&K Bank are stocks on our radar on the back of some negatives, at least to start with, in the red.
Welcome back. Here with us on Bazaar Morning Call, and markets across Asia, like I've been saying, are more green than up, which is why the implied open is suggesting that, finally we could actually start off almost 18 to 19 points on the positive side of the screen. So now, what about individual stock? We've discussed the big global headlines. Let's boil this down to the individual names that you need to keep an eye out on, and our research team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Manglam, let's start with Zomato. What drama, high drama towards the end of trade yesterday. So what came through on the call and the notes you've seen?
Well, from the call and the notes that we've seen, it's more of the same. What we saw in the shareholders' letter, the company went ahead and reiterated that in the call itself. They are advancing investments in the quick commerce business, and as a result of which, in the very near future, losses in Blinkit will continue. In fact, they say losses in quick commerce are largely on account of pulling forward these growth investments, and heightened quick commerce competition has led to a temporary pause in margin expansion. They said it in no uncertain terms. There is losses which are likely to continue, and there is a temporary pause in margin expansion out there as well. Food delivery revenue growth was slowing down because of weak consumer sentiment, and the EBITDA margins out there can cross and sustain above 5% over the next few quarters. District has crossed about 6.5 million downloads. Going out business, GOV can grow at over 40% for the next couple of years. But the street is still focusing on Blinkit itself. If you look at the trend, Blinkit, same time last quarter, had done a loss of almost 89 odd crores. And because of the increased investments, losses are at around 103 crores. So the street has cut their EBITDA estimates for this year, though they've increased their revenue estimates for next year because the growth has been increased because of the front loading of investments. A lot of target price cuts that have come by.
Okay, all right. Manglam going with red on Zomato, so we'll keep an eye out on that stock. But let's hop across to Abhishek. He's here to tell us about L&T Finance. Morning, Abhishek.
Morning, Nigel. It looks like a weak set of numbers coming in for L&T Finance. Net interest margin is at 6-quarter low of 8.5% versus 8.9% in the previous quarter. Asset quality continues to see deterioration, so gross NP ratio is at 4-quarter high. The AM growth is very low, just 2.3% sequentially, which is one of the lowest growth that you are seeing in the last 5 quarters. And this is on account of the fact that disbursements have slowed down massively. Disbursal growth is just 2.3% YOY, which is one of the weakest growth that you are seeing in the last 7 quarters. And sequentially, disbursements have grown by just 0.3%. Disbursal to AM ratio is also weak, that I've calculated close to 14% versus 28% in the previous quarter, suggesting that the tenure of the book has declined massively. Back to you.
All right, Abhishek, thank you very much for that. That's L&T Finance. Keep an eye out on the stock. We have the management, by the way, joining us at 9:40 this morning to take us through some of those numbers. MCX is the next one we want to address. Vamakshi is here with details. Vamakshi, morning.
Well, good morning, Prashant. The company reported a rather muted set of numbers. When you look at the growth rate, that has slowed down. In fact, in quarter 2, we saw double-digit sort of growth rate throughout, across the board. But this time around, the growth rate has slowed down to single digits. We're seeing a 6% quarter-on-quarter jump in the revenue. EBITDA is up 8%. The EBITDA margin too has improved by 125 basis points. But this is much lower as compared to 600 plus basis points improvement that we saw in quarter 2 of FY25. The net profit also saw a single-digit uptick of almost 4%. When we look at the key internals, nothing much impressive out here as well. Traded clients saw an uptick of 1.5% quarter-on-quarter. They now stand at 6.9 lakhs. ADT in futures and options both combined saw an uptick of 6.9%, and this growth is largely being led by the growth in the options bit. The market share has seen only a marginal improvement, so overall not a great set set for MCX. A con call is scheduled later today, so we'll be watching for commentary that comes through from the management, but going with a red for MCX as of now. Apart from that, lots of sugar counters in focus, and we'll talk about that later.
Yes, absolutely, because now sugar exports have been opened up, and we're going to come back to Vamakshi to figure out how that's helpful for the companies. But first, let's go to Sudarshan Dixon. Sudarshan, not bad, right? Stable for Dixon?
Good morning, Survi. So if you compare with the actual numbers year on year, you will see that all the operating numbers have seen a growth in triple digits, but numbers are largely in line with estimates led by mobile segment, which saw a growth of almost 190%. Now the contribution of mobile segment to total revenue has increased to 89% from 67% in the same quarter last year. And company is set to meet or beat the revenue guidance. If you remember, after Q2 earnings, company had spoken to CNBC-TV18, had said that in FY25 revenue will be close to 40,000 crore, and in 9-month FY25 it has done nearly 29,000 crore. On the margin front, it has a guidance of 3.7 to 3.8%, and in 9-month FY25 it has done 3.7%. Talking specifically about Q3 earnings, profit is up 123%, revenue has increased 117%, EBITDA is up 112%, and margin almost flat. It has come in at 3.7% versus 3.8% in the same quarter last year. Brokerages are large, have a mixed views on the stock considering rich valuations. But if you look at the commentary post earnings, it's very strong, especially on the order book, and that's the reason I'm going with green for Dixon Tech.
Okay, all right, and we'll be chatting with the management at 9:40 a.m. to detail the past quarter's numbers and get their sense about how things are shaping up going ahead. Let's go back to Abhishek. He's here to tell us about SBI Card. Abhishek.
Well, Nigel, you were on leave in December, and the December credit card data shows huge spending, especially you might have done on a lighter note. So industry data shows a huge momentum with respect to spends in the month of December. Now, total cards is up 10.5% YOY and about 0.8% month on month, but spends are up close to 14% YOY and more than 11% month on month. So average spends have increased by 3.2% YOY and about 10.24% month on month. SBI card data shows better momentum on a month-on-month basis. Total cards is up 9.5% YOY and about 1% month-on-month. The total spends are down 3.5% YOY, but they are up 12% month-on-month. So average spend is up about 10.8% month-on-month for them. With respect to their market share, in total cards, their market share has increased to 18.74% versus 18.69% in the previous month. Even the spends market share has increased to 15% from 14.88% that they had earlier. Back to you.
All right, Abhishek, thanks a lot for that. And I can confirm to you that in December, my credit card bill is the highest in entire 2024, but I can't say that it was a SBI card. Thanks a lot, Abhishek, for joining in with that. Now let's hop across to Vinny. She's here to tell us about a couple of real estate companies, Oberoi as well as Suntec. Vinny, take it away.
So both these companies have reported the Q3 FY25 numbers. Oberoi Realty, a strong performance that's coming from the company. Revenue seeing a growth of around 34%. EBITDA also seeing an improvement of 68% on a year-on-year basis. Margin seeing a sharp improvement, and profitability also is seeing a good improvement of more than 70% growth on a year-on-year basis. Now, what's led to this strong performance? One strong performance was across verticals of the company. So whether you look at the hospitality business, that's seeing a good growth of around 20%. EBITDA for the hospitality business is also seen a growth of around 11%. Improved occupancy across its annuity assets, that is also very good, as well as residential business that's reporting a pre-sales growth of around 144%. So that's going to be interesting to watch out for going forward in terms for the company. Margin also has seen a sharp improvement, mainly because of the higher share of the commercial earnings, as well as healthy margins in the residential business and healthy margins in the hospitality business is aiding the margins of the company. So expecting a green here. Suntec Realty, similarly, we're expecting green here as well. Revenue seeing a good growth of 281%. Profits, company has seen a profit this time versus a loss last year, and EBITDA coming in with a 48 crore EBITDA and an EBITDA loss of in the last year. Margins also seeing an improvement, and it's coming at 29.9%. What's leading to the improvement this time is in terms of the revenue that was aided by the additional units in Naigaon that was there for the project in BKC as well, which is supporting the growth of the company. And Suntec Realty is expecting a launch coming in Q4 FY25. Keep an eye out on that. They have good numbers coming in terms of going forward. Only thing to watch out for in terms of con call is the difference that is there in terms of pre-sales as well as the collection. That's lagging a bit, so we'll watch out for commentary on that front going forward.
Right, Vinny, thank you very much for that. Back to Abhishek. Paytm should be in focus, and J&K Bank also on the back of numbers. Abhishek, over to you.
Well, Paytm held its analyst call yesterday post-market, in which they have given their EBITDA break-even guidance to be in line with the earlier guidance. So the company had guided for EBITDA break-even, that is before ESOP cost profitability by the end of financial year, and they have reiterated the same. General guidance, the goal of the company is to have double-digit EBITDA margin soon, and they also want to have substantial PAT for them. Net profit break-even guidance is about 2 to 3 quarters due to steady fall in ESOP expenses, and they have also given another guidance. The company expects continued steady growth in its merchant loans as well. J&K Bank, disappointing set of numbers. They have lost market share, especially on the advances front. Deposit growth is about 9.65% YOY and 2.2% sequentially. The loan growth is very weak at close to 7% YOY and a decline of 0.15% sequentially. Net interest margin, however, improved both YOY and quarter-on-quarter, but their asset quality has deteriorated. Gross NPA ratio has increased by 13 basis points on a sequential basis. Back to you.
All right, Abhishek, thank you very much for that. And now let's go back to Vamakshi to figure out why sugar companies could be in focus and maybe they could see a bit of green. Vamakshi.
Well, absolutely, Surbi. They could see a bit of green today, and that is because, it is a CNBC-TV18 Newsbreak confirmed the government has gone ahead and decided to allocate export quota of 10 lakh tons for 2024-2025. Keep in mind that this is lower than what ISMA had earlier demanded, which was somewhere around 20 lakh tons for the exports quota. But overall, the impact is expected to be positive. In fact, a couple of days ago, when this news was sort of floating around in the market, we were joined by Prashant Biani from Elara Capital, and he had highlighted that this could be beneficial on the balance sheet as the inventory gets cleared up. The working capital could also, it could work out favorable in terms of that as well. But the margins could see only a mild uptick is what he had said. So overall, going with the green for all of these sugar counters.
Okay, all right. Got that, Vamakshi. Thank you very much for the details. Let's quickly recap our list of top stocks to watch. Now, the ones that have positive news flow around them, Dixon Tech, SBI Card, Oberoi Realty, Suntech Realty, Paytm, and sugar companies. The ones that could see some negative reactions today are Zomato, L&T Finance, MCX, and J&K Bank, all of them on the back of earnings. Well, that's the equity list for the morning, but how is the commodity market looking at Trump 2.0? We've got Manisha joining in with the latest. Manisha, I hope you managed to get some sleep because there were so many headlines and orders coming through the night, right? Interesting reaction. The crypto markets are a little, maybe a little disappointed, but maybe they know better times are coming. But yeah, tell us what you made of all of it.
Oh, well, absolutely, sir. It's been a very mixed market, and the street is still trying to number crunch, understand event, and digest whatever was said yesterday. And this is just the beginning. Let's get that. So I'll start with the crude oil prices, which have rebounded from its lows. The U.S. crude prices have continued to see further decline, rather. The U.S. president has now repealed 2023 memo that barred oil drilling in 16 million acres in Arctic. Also, there is uncertainty right now on potential adjustments to the U.S. sanctions on Russia. That is yet to come. But two things are very clear when it comes to energy. One, there's going to be a higher use of fossil fuels. Two, there's going to be more oil available. And three, U.S. does want to play a larger role in exports when it comes to crude oil and natural gas. So these are the things to watch out for. When it comes to metals, it also has been about the dollar index, which fell by nearly a percentage point yesterday. That was supportive. But then Trump has refrained from making concrete changes to trade policy, but has also said that the tariffs could be levied against Mexico, China, Canada on 1st of February. So the details of that, and until that happens, we are going to be looking at very choppy markets continuing. So while we have seen the safe havens like gold and silver gain up, the other metals have been slightly under pressure because when the U.S. president has revoked 2021 order that ensured 50% of all new vehicles as EVs by 2030, that would have meant more metal demand as well. Now, with tariffs, EVs, what is going to be going forward is something that will tell you on where the markets are. So until that happens, we're looking at choppy and slightly decline in copper, aluminum, zinc, steel, iron ore. All of these metals actually trading slightly in the negative in Asia right now.
All right, Manisha, thank you very much for that. So that's commodities in focus. We'll take a quick commercial break here. Sayan Mukherjee of Nomura India will be with us to discuss his outlook on the market. Has it changed in the last 12 hours or so? A little bit, maybe at the margin after Trump 2.0 and what he said. We'll ask him in just a bit.
Welcome back. So markets, like we've been saying across Asia, are managing to flash a little bit of green. And for us as well, the implied open is suggesting that we'll at least start off on the positive side, at least 20 points higher. But then what next from here? That is the question. Well, we've got Sayan Mukherjee, MD and Head of India Equity Research at Nomura, joining in. Sayan, we have you on a very interesting morning, right, where the announcements just have been non-stop over the last 12 hours or so. Now, take us through, now that this event, at least the inauguration, is out of the way, where does it leave us here in India? You yourself have been, in your latest note, you've been talking about the slowdown in corporate earnings. Then there is the global, backdrop. We have this flight of dollars, which has been absolutely unstoppable from India. So what do you see ahead next few months?
Yeah, thanks for having me and good morning. So I think, we will probably see more announcements in the days to come. So look, I know we are in an uncertain world at this point, and I think that's something which we feel is not very comforting. I mean, risk premiums can go high. It's already at a relatively lower level. So, we start the year with a fairly cautious note. As you know, like we have our year-end target, which is, expecting just around a low single-digit returns. So I think our expectations are muted, given that not only we are dealing with uncertainty at a global level, but also domestically, we are facing earnings slowdown, and I think we can see continuous earnings cut at least in the near term. So yeah, it's a bit of a cautious outlook, and one needs to be extremely selective currently.
Sayan, on earnings, let's just quantify that and get that out of the way. How are you looking at Q3? Because the big sort of hope was that, okay, first half was difficult, Q2 was an aberration, there'll be a pickup in the second half. Do you subscribe to that view or not? And for FY25, where are you on the earnings numbers, the targets?
So, FY25, I think we would probably see mid-single-digit earnings growth, somewhere around 5%, which is a substantial slowdown compared to the earnings growth that we had seen between, let's say, fiscal 18 to fiscal 24. I think the expectations now going forward are still elevated. When I look at consensus earnings for fiscal 26, we are looking at almost 17%, and year after it's around 15%. I think we have seen a strong recovery in earnings to GDP ratio, and we are in a cyclical slowdown as far as that ratio is concerned. So a significant outperformance of earnings growth to, let's say, 10 to 11% nominal GDP looks a bit stretched at this point. So we think we could see at least 3 to 6% earnings cut compared to what the consensus is expecting, and therefore from a next let's say year or 2 years, probably we will see somewhere in the range of low to mid-teens, somewhere around 13% earnings growth is what our expectations would be.
All right. Hi, Sayan. Good morning and good to see you in. But you're expecting the equity markets to at least give positive returns for this year? Because, I'm looking at the range. We're closer to the lower end of the range. I think we're close to 5% away from the lower end. But on the upside, it could get stretched to around 25,000 odd. So are we at the lower end of the range?
So actually, we just have around low single digit kind of an upside if you look at our nifty target for the end of the year. In fact, we are saying we could see possibly a negative year as well, and on the best case it could possibly be high single digit kind of a return, depending on how a lot of the stuff globally sort of plays out. So to us it appears that we won't see a sort of a massive outperformance. We will probably see another year of consolidation in 2025.
Okay, all right. Sayan, what about individual stocks and sectors that you like? I see that from the consumption theme, where there is plenty of debate out there, you're sticking to staples and you prefer them in comparison to discretionary. Tell us more about that. Stocks like HUL have done absolutely nothing in the last few years, but maybe now that could be the pocket to hide in. Tell us more.
Yeah, see, I think, as I was mentioning at the start, I think we have to be extremely selective. I mean, and we have already seen that, right? So if you see some of the performances, in the first few weeks of this year. I mean, in banking, in IT services, we have seen massive divergences in stock performance based on what the expectations were and how the results played out. So actually, it's a very, very, stock selective market, I think. But yes, on consumption, we think we had gone through a period of underperformance. I think at the margin, there is realization that consumption needs to get support, because I think from an overall growth perspective, it's important that we see some kind of support to consumption from a policy perspective. It has been largely supported. I mean, it has been largely, policy has been largely supportive of investments. But I think at the margin, we will see that it could come in the form of, let's say, lower taxes. And given the underperformance here and expectations running very low, we think on a relative basis, risk reward is relatively favorable for staples. And that's the reason we kind of gone with the Novobit call, for staples this year, given we don't have a very high expectation from the broader market.
Sayan, you have coverage on quick commerce as a space?
Yeah, we do cover, one stock there, yeah.
Okay, at the margin, what's the view now? I mean, is the best behind for now?
No, see, I think the narrative, on quick commerce has undergone a change. I mean, last year, the expectations were a lot more bullish. Now what we are seeing is rising competitive intensity in that space, right? So to that extent, it just, it hurts the sentiment at the margin. And, the space has done well. So if you look at the, stock performance over the last 1 year, it has significantly outperformed the market. And this is what I was, referring to. I think, expectations and the narratives have been extremely strong. And therefore, though the longer term story, we still remain constructive. We think the incumbents will probably do a good job from a longer term perspective. They have an edge. But the fact is, this incremental negative earnings because of higher competition can have a negative impact in the short term.
All right, Sayan, point taken. Thank you very much for joining us. Thank you for being here on CNBC TV18 on an important day like today. Appreciate it. We'll take a break here. Mitesh and Sudarshan with us on the other side, and we'll run you through some specific trades. Stay tuned.
Welcome back. Well, most of the Asian markets have managed to hold on to that green, albeit mostly at a flat line. The Japanese market's absolutely flat. Hong Kong's up. Shanghai is the one that's actually slightly lower. Taiwan's also flattened out. But for us, the good news is that the GIFT Nifty is indicating, the implied open that is indicating that we'll continue to build on that positive start. Look at that. It was about 18 points when we started the show, then 20, and now 46 points. So it looks like bulls will be off to the green side today. Let's take a very quick break. We'll come back on the other side and then we'll discuss the technical setup as well as the trades with Sudarshan and Mitesh.
Welcome back. Well, as promised, we have our technical experts with us, Mitesh as well as Sudarshan. Good morning, gentlemen. Thanks a lot for joining in. In a few seconds from now, we'll get the pre-open rates. But Mitesh, you go first. The dollar index has cooled off. And factoring that in, the GIFT 50 suggesting maybe we start off anything between 20 to 50 points higher. What's your take? Is it going to be a good day?
Morning, Nigel. So I think, there is a good chance of this being a positively biased day. One, we've closed right below 23,350, 360 zones. I think today could see some continuation and break beyond that. That's also the average of the 10-day exponential. That's also the area of the 10-day exponential moving average. So I think once we cross these levels convincingly, I think another upside of 150, 200 point kind of opens up. So I would be slightly positively biased unless until we see that the market fails to sustain the gap and immediately starts coming and trading below 23,340. So in case we start declining, then I think we are back to the range.
Okay, got it. Sudarshan, what about you? Mitesh is hinting at a mildly positive, day. He's leaning towards a positive day. What's your take?
Yeah, good morning. Well, yesterday I suggested going long in the Nifty with a tight stop at 23,100. That view continues. And that's good news because it means that a trend started and that trend is likely, at least as of now, is likely to continue today. So once we have a theme, that means that there is more confidence in the trend. I would suggest just raising your stops from 23,100 to 23,200. Keep a very tight stop loss. If you are long, stay long with that stop. If you are not long, look for a minor dip to buy. It is possible that we may be beginning, it's just a hope and some chart action, we may be beginning that pre-budget rally.
We may be beginning that pre-budget rally. Look at the rupee also. That is substantially higher. Substantial strength on the currency coming through. I think that flash came and then disappeared. We'll have it back on, but I think opening much higher as compared to about 1/3% higher as compared to the dollar this morning. So 86.31 on the dollar rupee rate at this point in time. Gentlemen, good morning. In terms of specific, there you go, 86.28 compared to 86.57. So the dollar is broadly lower everywhere, and emerging market currencies, etc., are seeing some of that pressure come off. Sudarshan, specific stock trades?
Well, it's all, again, a buy list. Markets do go up. UPL is a buy with a stop under 545. Divi's Lab, which has already been in a strong uptrend, has a minor dip and a sideways move. Buy it there with a stop under 58.70. Similar pattern for Granules, decent up move, now a minor correction and sideways, sort of move, apparent imminent uptrend. Buy Granules with a stop under 585, and National Aluminium is a buy with a stop under 205. So all four are buy ideas.
Mitesh, what about you?
So I have a majority calls on the buy side except one sell. On the buying side is Kotak. Now, yesterday, we had a very massive move over there. So buying at such a high level could be slightly risky, but look at the overall pattern, and getting past this 1900 mark was a very important thing on the short, medium as well as long-term chart. So Kotak, I would recommend buying with a stop at about 1895 or just maybe a rupee or 2 rupees below it, and a target of 1970 to begin with. Bajaj Finserv is a buy with a stop at 1712 for targets of 1790, and Divi's is a buy with a stop at 5944 for targets of 6150 in the short term. One sell call though, that's Infosys. Keep a stop at 1835, look for targets of 1755.
Okay, we'll come back to both of you in a bit from now for more trades, but thank you for joining us now, Mitesh and Sudarshan, with that. Well, one of the world's foremost macro investors who's got an extremely successful track record of making big macro calls is Stanley Druckenmiller. He spoke with our sort of sister channel, CNBC, in New York, and these are his comments around Trump, tariffs, inflation, the Fed, and of course, market positioning. Listen in.
We're probably going from the most anti-business administration to the opposite. So we do a lot of talking to CEOs and companies on the ground, and I'd say CEOs are somewhere between relieved and giddy. So we're a believer in animal spirits. Paul Ryan was on your show last week talking about a 32% increase in business confidence over the last 12 months. I think that's probably a record in terms of change. So the economy looks very, very strong, at least for the next 6 months, which is about as far out as one can see with any degree of confidence. I would say it's complicated. Despite what I just said about all the wonderful things about the economy, we have an earnings yield to bond yield, probably the most unattractive level, not probably the most unattractive level in 20 years. So you're going to have this push of a strong economy versus bond yields rising in response to that strong economy. And that kind of makes me not have a strong opinion one way or the other on the market. I will say this. In my business, every change creates change in security prices, and having this kind of radical change from one administration to the other in addition to what's going on in the private sector with innovation, then you got deregulation from the government, disruption. I think there's going to be plenty of change and plenty for your viewers to do. I wouldn't worry about the market. I'd focus on individual stocks. I still have a short in treasuries. I know a lot of people have been surprised by interest rates rising after the cut. Of course, we weren't, because I thought the Fed was making a mistake. And I was worried about the same animal spirits we've been talking about, and of course, our horrendous fiscal situation. Having said that, we've come quite a ways. I think we're probably in the 7th inning, but sometimes you can make a lot of money from the 7th inning to the 9th inning. And who knows if the Fed stimulus into a melt up in asset prices with the kind of animal spirits I talked about give you upward inflation, which is not our forecast, but we're definitely open-minded to it, and we're not expecting lower inflation. That could tip the bond market and create a problem. So we're still short treasuries, but we're certainly not pressing the size of that position now. As you know, we have a big fiscal problem. Mandatory spending plus interest expense is literally 100% of revenues right now. And both sides of the aisle have said they are not about to cut entitlements, which is the elephant in the room. Having said that, because of that, we need pay-fors. So our main choices are an income tax and a consumption tax like tariff. So when I say tariffs are the lesser of the two evils in terms of those two, because we have a fiscal problem, we need revenues. Tariffs will generate revenues. We also have a private savings problem in this country. They're far too low. So I think a lot of economists who are out raising the alarm bells about tariffs would probably be fine with a consumption tax. Scott's extremely capable, big brain, very thoughtful. He's in the unique position that I don't think any other Treasury Secretary has been in, where he's been an active participant in markets, as he said in his confirmation hearing. He's been to 40 countries. I know he's been involved in markets in at least 40 countries. So he's extremely capable. He understands the fiscal situation. I think he understands that the biggest risk to this administration is both fiscal and inflation. Having said that, he's not in charge. He's extremely persuasive. He had no problem persuading me many times when we worked together, but I just don't know how it's going to work out. This is a huge, huge problem he inherits. The deficit is currently at 6.7% of GDP. It's $1.9 trillion.
Okay, by the way, the pre-open rates are in, so let's do a quick check on this. The Nifty in the pre-open is up about 76 points, so it's looking good. And leadership is pretty much across the board, actually. I mean, you've got the likes of L&T doing well. There's SBI that's doing quite okay. Some of the metal counters are up and about. Remember, because of this pullback in the dollar, there's a bit of a global trade, risk-on trade that's built across different asset classes, including metals. And that seems to be showing up. Hindalco, JSW Steel, these are stocks on the upside. I must, however, add, look at Zomato in the pre-open. Not sure if this is how severe it's going to be. But in the pre-open, Zomato is down another 7% after yesterday's about 3.5% decline adjusted. The concern is very much out there, and the company has said it upfront that Blinkit is going to be suffering losses for now because of the store rollout, accelerated store rollout, and the fact that there is competitive intensity, and the price cuts, I think, are now beginning to get that reality is sinking in, and there's about a 7% drop. Let's see if the buyers come in at some point in time. Like Science said, in the medium term, for instance, Nomura is still constructive on the space. But for the time being, let's move on. From the US, let's head to Davos, where we've been getting lots and lots of insights from the top business leaders and political leaders as well. Now, this is an exclusive conversation that Shireen had with TVS Motors management. The company aims to outpace industry growth in 2025. That's the word coming in from Managing Director Sudarshan Venu, speaking to Shireen from the sidelines of the World Economic Forum. He says the company is broadening its EV portfolio, and that remains a key focus area.
Absolutely, we are seeing signs of improvement in the first 3 weeks of January. I think because of the election and things, certain government capex had to be slowed down. But post the monsoon, there is a pickup. And the first 3 weeks of January are very exciting. And this sets a very optimistic tone for 2025. I think we are definitely looking for double-digit industry growth this year. And TVS will aim to continue to grow ahead of the industry. I think we committed a few years ago that we would invest 250 million. We have made that investment. You are seeing the products, you're seeing the growth. There are more products this year, and with that, we'll share more capex plans as well. We're a global company. We cater to so many markets, and we will further that in EVs as well. We have launched iQube in some markets outside India. The electric scooter for BMW is designed, developed by us, and is selling in European markets. We will make more launches as well, including a premium off-road motorcycle and some other vehicles as well in the coming year. So this is something that is exciting, and it continues to grow, and you are seeing greater premiumization of vehicles as well. I think it is a sign of the Indian consumer having a little extra disposable income, and also sort of with that and the technology that is now available in terms of connectivity, in terms of safety systems. These are all very exciting.
Okay, all right. Well, let's get back to markets. Then we have Sudarshan who joins us to help us out with his 9-10 call. Sudarshan?
Well, consider buying Granules. Granules is a buy with the stop under 585.
Got it. Mitesh, what about you?
I recommend a buy on Bajaj Finserv for targets of 1790.
Got it. Thanks a lot for that, Mitesh. Well, let's hop across to Abhishek. He's here to revise a couple of stocks for us. SBI Cards is top of the list. Abhishek, take it away.
Well, it looks like there was huge spending done by people in India with respect to spends on credit cards in the month of December 24 versus November 24. So total cards were up 10.5% YOY and about 0.8% month on month. In that, the spends were up 13.9% YOY but 11.1% month on month. So average spends were up 10.2% on a month on month basis. SBI Card also saw strong momentum. Total cards being up 1% month on month versus industry average of 0.76% month on month. The total spends were down 3.5% YOY, but it increased 12% month on month. So average spends per card actually grew by 10.8% month on month. So with respect to the market share, the total cards market share increased to 18.74% versus 18.69% on a month on month basis, and the spends market share increased to 15% versus 14.88% in the previous month. Back to you.
Okay, all right, got that. Thanks for that, Abhishek. Let's revisit Dixon as well, because Dixon's numbers are looking really good. I mean, at least year on year, there's a growth of over 100% on most parameters. Let's go back to Sudarshan and get the highlights. Sudarshan.
So that's right. So all the operating numbers have seen a triple-digit growth, but if you compare with the estimates, numbers are largely in line. And brokerages too have a mixed views on the stock. First, Goldman Sachs is a sell call with a target of 10,240 per share. It says earnings upgrade cycle may have halted for time being. CLSA has an outperform call. It says triple-digit growth continues, but focus would be on ROCE expansion. Jefferies has an underperform call and target is rupees 12,600. It says Q3 was a beat against its estimate. Now taking some lines from the con call, company continues to focus on 2 to 3 things. First is capacity addition. Second, adding more products. And one segment that is company is bullish on is telecom product. It says this segment will be the key growth driver going forward. Lastly, company's performance against the guidance in 9-month FY25. Company's margin is 3.7% against its FY25 guidance of 3.7 to 3.8%. Revenue in 9-month FY25 is 28,568 crore against company's actual guidance of rupees 32,000 crore. But need to remember is post Q2 FY25 earnings. Talking to CNBC-TV18, company had said in FY25, it will do revenue that will be close to 40,000 crore. So numbers were in line, but just on the commentary basis, it looks largely positive.
All right, and we'll have the management join us a little later on the program to talk to us about the numbers and the outlook as they stand right now. Just about a minute to go for the market open. Dixon, of course, in the pre-open is down 1.7, but the Nifty is up 75 points. 23,420 is where we are at right now. Let's just look at, the other indices as well, because that's what we'll do to begin the day. And then, of course, we'll, as always, look at individual names, etc. So it's going to be a higher start, but it's also going to be a little tentative with everything which is happening. I think we've got the first rates because the prices are changing. And making up their mind, right? I mean, what's happening? So 23,420, about 1/3% higher, and kind of flattish to slightly up. The bias is up. Nifty Bank is up about 1/3%, 49,500 or so is where we are at. The sensex is now flattish as well. The mid-cap index has slipped into the red, but again, It's not got very much on it. So about 90 points lower on the Nifty mid-cap index. Look at the Nifty heat map. Most stocks, about 40-odd names, are higher. So predominantly, the tinge is green, although it may not be by very much if you look at individual names and how much they're doing on the upside. But lots of other stocks in the broader market, etc., as well in focus. Surabhi.
Okay, let's start with the big news maker. Zomato is down 8.5% at the open. There are a lot of target price cuts that have come in. But for me, the CLSA call stood out. They are still at 400 on the stock, and they're saying that while they've cut some of the estimates, but they're overall looking at the better GOV as the glass half full rather than half empty. Anyway, the market's big debate is on this one. 8%. It's the stock of the morning. Let's move on and look at what's happening with the Nifty. The gain's about 45 odd points at this point in time. Apollo Hospitals, Ultratech Cement, Tech Mahindra, Cipla, Hindalco. So it's mixed across sectors. There's some buying on tech. TCS is up about 0.5% as well. There's Eicher Motors, there's Lever, there's ITC. So it's all over the place. No real clear sectoral trends. But yes, overall technology stocks are doing quite okay this morning. Infosys, HCL Tech, Tech Mahindra. There's a tinge of green on most of them. On the downside, Trent losing about 1%. There's ONGC, which is down about 0.7%. NTPC is lower. Kotak Mahindra Bank, after yesterday's blockbuster, is cooling off just a little bit, just 0.5% lower on Kotak. Let's see what Wipro is doing, considering Wipro had a great day yesterday. Wipro is building on those gains, about 1% higher on Wipro. So not too bad. But yes, the mid-cap index has already slipped into negative territory, about 0.2% lower. And the headline of the morning is Zomato and even Dixon. Nigel, look at this one. 7.5% gone from Dixon, though the numbers like Sudarshan saying up, 100% growth.
Well, on Dixon, I think one of the brokerages had made this very, very pertinent point. Jeffries, I think, that Dixon is a non-branded B2B EMS player. They have 85% of their sales as OEM with lower margins. Even so, it trades at a higher multiple than some of the B2C companies. So because of the valuation aspect, I think that's the reason why the stock has pulled back today, because the valuations now of Dixon are more than some of the clientele. So that's the reason why, in fact, that's when we'll discuss that in greater detail. The stock of the morning from the real estate pack is Sunteck Realty. Take a look at that stock. It's flying away. It's up close to around 10%. If I'm not mistaken, this has been a relative underperformer actually from the real estate basket. But this morning, it's a stock of the morning. So big move is what we're seeing on that particular name. AGI Greenpack, that's another stock that's opened up with a gain of close to around 6%. I'm not sure whether or not we have some news flow on that one. I think it came out of that set of numbers. So AGI Greenpack is another one that's opened up well in the green. Zomato, the low of the day, it's around 218. Now that's very, very important that it defends that mark. Otherwise, we could see a further slide. As of now, it's at around 220 rupees. Newgen Software is down close to around 5%. So that stock as well is pulling back. And Oberoi Realty, it's at the opposite end of the spectrum. So Oberoi Realty, that's been an outperformer, that's pulled back close to 5%. While Sunteck Realty, that's been an underperformer, that's up close to around 10%. Prashant.
Well, you got 50 points now on the Nifty, just to kind of summarize the action. But this is the initial first couple of minutes of trade and how we are starting the day. Biggest volume-led gainers are Lakshmi Dental. I think 5%. It's number one in terms of volumes. I think listed yesterday, and 577. Yeah, there you go. 1 million plus shares on it, and 5% higher. KRN. I think this is also recent listing. KRN Energy, the heat exchanger company. I think 7.5% higher. 890 on that one. So it's got very large volumes. Apollo Hospitals is up 2%. I think we mentioned Sunteck. APL Apollo reported numbers yesterday. Stock's up 3%. It's got very large volumes. Ola Electric is coming up with a 3% pop. 79 on decent sized volumes. HPCL is up 2%. So maybe look at IOC and BP as well. Lower oil possibility ahead. Reddington is up 2.5% odd. NetWeb is up 2%. NetWeb sold off 5% yesterday after results. I mean, that's it. That's the big volume-led list so far. At least Zomato and Dixon are the two big casualties. Both are down 2%, 7%, beg your pardon. 7.25% on Zomato and about 8% on Dixon right now. Kalyan Jewellers, which after about 10 days of losses saw about a 6-7% pop, is back down about 2%. There is Paytm, which is down 2%. And look at something like a MCX. MCX is starting 4% in the red. at about 5,800. Najib?
Well, just 2 points, Prashant. One is on Kalyan. You know, they put out a release yesterday. The promoter entity had some pledge on the shares that they held. They've increased the pledge out there. So that's what's causing some nervousness. So that's point number one. The other stock I'm looking at is Welspun Corp. You know, it's close to a 52-week high. And we've been making this point. We had the management a couple of times as well. Trump is talking about drill, baby, drill.
Yeah.
And in fact, if he's going to drill more, then he'll require pipes to transport it. And this is one of the companies that could be a potential beneficiary because they have their facility in the United States. So it seems, you know, otherwise you'd normally see a bit of a pullback on some of these stocks when the markets are weak. But given the mid-cap index has pulled back and this is closer to around 52-week high, this could be one of the potential beneficiaries if Trump does what he says, that is drill more and make US, more self-sufficient with regard to oil and gas.
All right. Let's take it to Nilesh Shah now. He's Managing Director and CEO at Envision Capital. Nilesh, good morning. Great to have you with us here on the program. Thank you very much. So we are still kind of in the phase of finding out what will happen. And I'm not sure if we will remain in that state for some time to come, a state of expectation and not knowing. So a headline watch in that sense. But for bottom-up investors, I mean, it's I guess any other day with some entertainment added for people like you, Nilesh, in that sense. Your thoughts as you look at this new phase in markets? Maybe I'm exaggerating it with Trump 2.0, but your thoughts? Nilesh, you'll have to unmute yourself, please.
Yeah. Hi, Prashant. Sorry for that. I guess it's one more year, one more day, and one more event. Eventually, like what you rightly said, a fundamental bottom-up approach always holds you in good stead. And I think that kind of an approach even remains even now. Yes, 2025, you're going to have a bit more of macro headwinds, global macro headwinds. There is a new presidency in the United States, and policy initiatives, especially on the tariff side, will have significant implications. But having said that, I believe what's going to be even more important is what the central bankers do in terms of interest rates. I believe interest rates will be a bigger trigger and a bigger catalyst to watch out for in 2025. And that, to me, remains the biggest kind of variable as far as markets are concerned. So clearly, from a global macro perspective, I clearly believe that what the central bankers will do in 25 will be way more important than what the new presidency does in terms of policy initiatives.
Okay, Nilesh, hi. Good to have you on the show. So I think markets are just trying to figure out what this means. We spoke to a couple of international experts, and I think the view seems to be that for the US equity market, at least the party is intact. Now that boils us down to here, what we're doing at home. So what's the sense? I mean, the immigration policies will become clearer, I think, in the coming few weeks. But as we await that, let's talk tech and what you've seen and heard from the companies so far. What would your view be? Would you buy large cap or niche mid cap? I mean, how would you look at taking exposure given all the uncertainties at hand?
Survi, I believe that, this whole issue around immigration is probably just overly debated. And I think the impact of that is a little exaggerated. The Indian IT has moved on, and as there is more automation, more around robotics, I think the growth potential is not going to be really a function of more the kind of hiring or the kind of more people that you can send on an on-site basis. So I believe that the whole challenge or the issue around immigration is probably a bit overestimated. I honestly don't think it's going to move the needle. What's I think we need to realize is that for the large cap IT, it's going to be essentially the US GDP growth rate and the spending on technology. Even if you look at the last decade, which has been clearly a landmark decade in terms of adoption of technology, digitization, our Indian IT companies have at best grown at 10% in rupee terms. You strip out 3% of depreciation of the rupee. In dollar terms, the growth is 6-7%. And that's essentially what is the sustainable growth rate. So my view is that for growth investors, the large cap IT space doesn't make sense unless you are a benchmark driven investor. And there are plenty of opportunities in the tier 2 IT space, companies which are essentially going to be AI developers or going to create solutions around AI for global companies. Those are the kind of companies which will probably kind of be the better place to be. They are going to be the growth frontiers.
You know, Nilesh, I remember when we've spoken about playing the new side of technology in the past. I remember our conversations. You've been fairly optimistic on some of the platform plays as well, right? I mean, it's consumer tech. And now we're in the midst of a very interesting debate. I mean, Zomato's triggered that debate yesterday by saying that as they invest more in growth and they accelerate their store rollout plan, there's also intense competition, which is why their margin expansion, at least in quick commerce, is on a temporary pause. What do you make of this? I mean, there's pretty dramatic reactions playing out on the stock even this morning. Not just Zomato, I'm just saying general quick commerce and consumer tech.
Yes, Surbhi, we own a bunch of these platform companies. Yeah. We really have been in this space now for a while, and we continue to like it. We clearly believe that these are going to remain the wealth creators and the winners for a very, very long period of time. In between, there could be challenges for a quarter or two as companies essentially either accelerate or tweak their growth strategies. There will be competitive intensity, and in some of the cases, maybe some of the growth strategies may not work for a short while. We've seen, for example, like what the Zomato management itself has said, and we own the stock, itself said that, look, they saw a similar thing playing out in the case of food delivery, where they went in aggressively and then had to pull back later. It's quite possible that quick commerce will also witness a similar situation. So it's honestly not going to be for the faint-hearted or for the more short-term oriented investors. So if you're looking at the next 1 or 2 quarters or maybe 4 quarters, it may not be the right place to be. But if you have a 3-year, 5-year, or 10-year view on this whole digitization opportunity, we have to use these weaknesses to essentially continue to buy and load up on the space. So I would still continue to be a long-term believer on some of these companies.
Okay, a very valid point there, Nilesh. For the longer term, they still have plenty of headway over there. But otherwise, in the near term, that could have some challenges. Got that in terms of these players. But Nilesh, let's talk about another set of stocks that the street has been very excited about. The EMS plays, so much of potential, big runway for them, but valuations are something that's worrying. Dixon Technologies today, very, very good numbers, much better than what the street was working with. But the stock is down 6%, telling you clearly that these valuations now are weighing on some of these names. Your take on the space?
EMS continues to be high potential, but clearly believe that at these kind of valuation, I mean, the valuations don't make sense around this time. I mean, when stocks are trading at whatever, 120, 150 times trailing earnings, the reality is that these are B2B businesses at some point of time. Clearly, the growth outlook will catch up. These are businesses which will not keep growing at very, very high rates. We've seen this kind of movie really play out, 20 years ago when it was IT services, or maybe a few years ago, we had the chemical companies. We had so many companies coming out in the chemical space with IPOs, and we saw clearly that after a few quarters, growth didn't sustain, and therefore valuations essentially moderated. The stock prices didn't go anywhere. It's quite possible that the EMS space will face similar challenges at some point of time. Hard to really take a call when that will happen, but these valuations, I don't think they really make sense.
Okay, so valuations are a concern. Got that. By the way, just a quick glance back on the screen, and it's still the same picture. The bank nifty is slightly lower, flat line with a bit of a negative bias. The mid-cap index is also absolutely at the flat line. The nifty is retaining a bulk of its gain. It's the best performing index right now with an up move of about 60 to 70 odd points. That's the market picture. Nilesh, so there's so many uncertain moving parts. There is Trump and tariffs and policies. There is the earnings slowdown here in India. Everybody agrees that earnings downgrades will happen even for FY26. There is this trying to second guess what the Fed and the RBI will do. In the midst of all of this, let's talk buying ideas. So you've mentioned your views on IT and, of course, the platform companies. What else? What else to buy in this uncertain time?
So clearly, we saw last year that there was a bit of a kind of a slowdown for some of the capex kind of companies, companies which were essentially supplying equipment or components to the capital goods sector, or companies which were essentially part of the entire railway opportunity or the defense opportunity. And that was on the back of a slowdown in the government's expenditure. Clearly believe that that is likely to resume in terms of the growth and the allocations. We'll get to know that on 1st of February in terms of the government's allocation for the new year. I clearly believe that opportunities around railways, around defense, around renewable energy, and companies which provide equipment and components or consumables to that space, clearly I think it's a good time to kind of start looking at them. In many cases, the valuations have come off, P multiples have come off. It might just be an interesting space to watch out for. So clearly believe that I wouldn't be surprised if by the end of this year, they end up being essentially the winners.
All right. Nilesh, I want to ask you about these gold jewelry themes. In the last 1 year, if I look at it, Kalyan was the one that zoomed ahead, and Titan actually was the underperformer. But now, in the last couple of weeks or so, we have got back to hearing that Titan is equal to trust, and that's the only one that's done well in the jewelry space. And for a longer term investor, Titan does well. Keep in mind, it doesn't trade cheap at all. But at least, if I pull up a couple of charts, last 1 year chart, if I pull up a last 1 month chart, it appears again, Titan could be finding, its way, because in the past, you've seen PC Jewelers, Gitanjali, Tara, and the list goes on. But only this one has actually stood out and made some money. Your take on this space and the themes?
The space continues to be very interesting. I clearly believe that the opportunity around premiumization, the opportunity around aspiring middle class, these are long-term themes. And so clearly believe that the tier 2 jewelry companies essentially are a good place to be. This is a space which has corrected. Obviously, for the year 24, this was a space which did extremely well in terms of stock prices. So clearly believe that, yes, there is some bit of correction, there has been a fair bit of correction which has happened. Maybe there's some bit of correction to happen as there's some pressure on the mid and the small cap space. But my sense is post maybe, the March quarter, post the June quarter, these will again kind of come out as meaningful long-term opportunities. So clearly believe there's lots of room to grow. The big difference between, what happened maybe a few years ago with some of the emerging jewelry companies, I think their big challenges were around cash flows. These were some of the companies which had huge amount of debt. They didn't have the cash flows. But the bunch of tier 2 companies that we are seeing in the jewelry space, these are companies which essentially have a calibrated growth strategy. They don't have too much of debt. Maybe some of them don't even have debt. They have been able to successfully raise capital and capitalize with themselves. So they have the growth capital to grow. And I think that's the big differentiator. Some of them, their franchisee strategy is working out to kind of do well in early days, but it's working out well. So overall, in terms of the space, the strategy, and the balance sheet, I think are very, very different from some of the earlier emerging names that we had seen a few years ago. So I would be constructive on this space.
Okay, all right. And Nilesh, got that. Thanks a lot for joining in. Always good to hear your thoughts and looking forward to chatting up with you in the coming weeks as well. By the way, when we were having that chat with Nilesh, take a look at what happened to the markets. The Nifty from trading with a gain of around 50 points. That's now flat. In fact, it briefly moved into the red as well. I think the sensex actually is already in the red. So just pull up that. And a few stocks that have come in for profit taking. I think the big boy Reliance Industries, that's been the driver for the last few trading sessions. It just moved down a little bit, 0.5% odd, but it has a huge weight on the index. So that's why we're feeling the weight of that. Kotak Mahindra Bank is cooling off a little bit. And Trent as well, now on the verge of breaking 6,000 rupees odd. Conflicting brokerage reports we have in the last 1 week or so. But for the time being, Trent is moved closer to around 6,000 rupees or so. Well, time for another corporate interaction then. L&T Finance, that's the stock on our radar for Q3. The dispersals were weak, margins saw a sharp decline, while the gross NPA ratio is at a 4-quarter high. To speak about the past quarter and the way ahead, we're joined by Sudipta Roy, the Managing Director, as well as the CEO at L&T. Good morning, Mr. Roy. Thanks a lot for joining in. Well, you were sounding quite optimistic about Q3. But dispersals, well, they were quite tepid. What happened in the past quarter? If you could explain to us what is the run rate you're looking at in terms of dispersals for the fourth quarter? And what does it mean in terms of AUM growth for FY25 and FY26? Please go ahead.
Yeah, so if you see the disbursals that we did in Q3 at 15,210 crores were actually the highest ever for L&T Finance. So in a way, but what we have done actually is that if you look at the sectoral disbursements, obviously we have done adjustments within the sectoral disbursals. We tapered down our disbursals in our rural business finance, which is our JLG segment, microfinance JLG segment. And we sort of calibrated it, obviously, in view of the current macro situations in the microfinance industry. In terms of our tractor disbursements, our actual tractor disbursements were actually very, very good. In fact, our highest ever tractor disbursements we saw in the month of October. So overall, on the back of good monsoons, we had a very good quarter in terms of tractor disbursements. In terms of two-wheeler, yes, two-wheeler was a little bit of a range-bound disbursement, primarily because we focused more on quality customer, onboarding quality customers in the two-wheeler business. And as you can see, we put out an analyst report is that a prime share of our two-wheelers is close to about 65 to 70% in terms of onboarding. In terms of personal loans, actually our personal loans disbursement did quite well. You will see on a year-on-year basis, our personal loans disbursement has grown by almost close to 94%, albeit on a lower base. Okay. And in our SME disbursements also remain on a sort of range-bound pattern. So overall, yes, the disbursements from a sequential point of view did not move much, primarily because of the conscious call to temper down our disbursements in the JLG microfinance sector, primarily because of the ongoing credit challenges in this sector. However, we remain hopeful that as and when we see signs of tempering down of the credit stress in the microfinance sector, we will be able to resume our risk-calibrated growth pattern going forward.
But what is the run rate then? 15,000 crores of quarterly run rate. You're seeing quite satisfied with the performance in quarter 3. For quarter 4, what kind of disbursal should we look at? And what does it mean in AUM growth? If you could help us out in percentage terms.
See, right now, this quarter-on-quarter basis, our AUM growth has been around 23% odd. So the fact is that, again, the critical thing is that what is the pace of the microfinance and the JLG disbursement in the next quarter as well. Given the fact that we do not expect full resolution of
Mr. Roy, the 23% you're talking about is in the farm equipment business, right? The year-on-year growth.
No, so overall retail book, we are talking about a 23% growth rate on a year-on-year basis, and the console book grew by about 16%. But the retail book, if I talk about a year-on-year basis between quarter 3 of this quarter 3 and the quarter 3 of the previous year, there's been a 23% growth in terms of the retail book. Sure. In terms of disbursement trajectory, we expect, typically quarter 4 is a strong quarter in BFSI. Typically, BFSI exhibits a strong quarter trends. However, one thing we will like to point out is that our disbursement trajectory in quarter 4 will be risk calibrated. We will not take any unnecessary risks during this quarter, and we are not chasing any sort of headline number during this quarter. We are very, very clear that whatever disbursements that we do will be risk calibrated, such that the risk outcome is positive. So we are hopeful that we should be able to maintain the same trajectory as we saw in Q3 FY25. However, as I said again, I will reiterate that point again, that we are not chasing any numbers, and all our disbursement will be risk calibrated. So we will disburse according to the market risk perception as we see.
Which is why, Mr. Roy, if you could just give us some more color and let's dive a little deeper. Rural, JLG, rural, these are big segments for you, and you've gone slow both quarter on quarter and year on year. Yes. If the same trend plays out, because you're saying that you're going to be very, very risk calibrated, if the same plays out in Q4 and you go slow on these segments, then what should we expect in terms of total AUM growth for FY25? And within these segments, what is the qualitative input on stress? I mean, overall, the gross NPA has gone up a little bit. But within rural, within micro, are you expecting more stress to build up in the coming quarter?
See, I'll take your last portion of the question first. In the site is that we have seen some green shoots of recovery in this quarter. If you look at the collection efficiency numbers that we put out, our collection efficiency improved to about 99.49% in December. And in January also, we remain in a holding pattern. So given the fact that we have seen good monsoons, we have seen good Kharif arrivals, and the Rabi sowing has also been good, we are hopeful that the rural liquidities will improve in Q4 FY25, and such that our collections efficiencies will probably be on a improvement trajectory. However, the exact improvement trajectory needs to be seen. Overall, though we have guided as part of the Lakshya targets to have a 25% year-on-year growth target, what we'll try to do is try to see as to whether we are able to sort of close the year at an overall AUM growth on a year-on-year basis of above 20%. That is what we will try to look at. Some of the lines of businesses are growing well, though we have purposefully downward calibrated the disbursements in the RBF segment. Some of the segments, even in the RBF segment, we are sort of focusing on disbursing to non-leveraged customers, sort of expanding in the non-leveraged markets like AP and Telangana, where our collection efficiency continued to be 100%, Western UP, where our collection efficiency continued to be 100%, Western Maharashtra. So certain non-leveraged markets, we are trying to penetrate a little more, as well as try to improve our focus on, even in the markets that we operate in, focused on customers that have lower leverage. So we're trying to see as to whether we can keep our disbursement momentum even in RBF risk calibrated, but still on a forward trajectory. We are growing the personal loans business. Most of our digital partnerships are firing up well. You can see on a year-on-year basis, our personal loans business has grown by almost close to 94%, albeit on a lower base. And again, the two-wheeler business, again, we are seeing a resumption of, we saw a dip in the two-wheeler disbursements in the month of December after a reasonably good October and
Mr. Roy.
We are seeing again the disbursement momentum coming in back in the month of January. So overall, 20% plus on a year-on-year basis is what we are targeting.
Yeah, Mr. Roy got that point, 20% growth in business. But if you could just elaborate on that, you said you're seeing some green shoots. You mentioned collection efficiency looking good in some markets. But tell us about the gross NPA levels at company-wide level. How do you see the gross NPA figure trending? And also specifically for MFI, what can you guide on in terms of the NPA levels?
So see, if you see our GS3 numbers, our GS3 numbers are currently at about 3.23%, has gone up marginally from 3.19% in last quarter. But obviously, we have used about 100 crores of macroprudential provisions this quarter. Next quarter, and this is primarily focused on our rural business finance book, as some of the sort of the stress assets have keep on flowing and sort of finally, come into the provisioning status. We expect that, some of our credit costs will remain elevated also next quarter. So, next quarter, we expect that our GS3 numbers and our NS3 numbers will go up again sequentially slightly more. And that is why we have sort of kept a provision, and we have said that we have used 100 crores of the macroprudential provisions this quarter, and next quarter we have kept provision for about 300 to 350 crores of macroprudential provision usage next quarter. If you see on a quarter-on-quarter basis, our GS3 has gone up by about 100 crores odd, and on a year-on-year basis, our GS3 has gone up by about 450 crores odd. I expect, similar about 100 to 150 crores addition to the GS3 number next quarter as well.
Got it. We'll leave it there. Thank you very much for joining us, sir. Good luck, and we'll speak again soon. Thank you. Well, the next company I want to address is Dixon Technologies. Stock is under pressure, largely, of course, on the back of rich valuations. Numbers were in line with expectations, so they reported a very strong growth, largely led by the mobile segment, which has really pushed the overall numbers to where it is. Mr. Atul Lal is Managing Director at Dixon. He's joining us now to take some questions. Mr. Lal, good morning. Great to have you with us here, sir. Thank you very much for your time. Prashant this side, and it's been a while, so good to see you back on the channel. So just the basic hygiene numbers out of the way to confirm more than anything else. For the full year, at this current run rate, you should be at 40,000 crores in top line and about close to 900 crores in profits?
Somewhere close to that, Prashant. Yeah, you're almost there. There can be small delta here and there, but largely we're going to be close to the number that you're mentioning.
Okay. Got that. Now, before we, and there are always lots of things to talk about with Dixon, because you're backward integrating, you're getting new customers on board, and there are other newer segments, etc., which you're building out as well. But the main bread and butter, the mobile sort of segment, Mr. Lal, if you can tell us, I mean, this particular quarter has seen tremendous growth. I mean, actually, maybe at the expense of some of the other segments which have not grown as much. The share of mobile within the overall pie has actually increased quite a bit. At the margin, as we look at 2025, are you seeing any slowdown at all from a demand perspective? You know, I was reading this report from Counterpoint Research, which essentially was, I mean, they put out the big numbers. They said that, this is the total mobile manufacturing capacity at the end of 2024. And as of now, only about 50% is utilized. 50% remains unutilized. And they were sort of pointing to sort of slower demand, etc., which they think will pick up in 25. Just wanted your thoughts, sir. So,
Prashant, undoubtedly, mobile is the largest category in our industry, and strategically we started positioning ourselves in a key position there. So that is the biggest growth factor for us. We have grown from 5 million odd smartphones last year to almost 30 million this year. Practically all the brands in the Android ecosystem are our customers. With the latest acquisition that we have, in next 6 to 8 months, we should be almost at 70 million. Please appreciate the Indian market is around 150 million, and Android ecosystem is going to be around 135 to 140 million. So we have a very large play in this. So we have grown from 5 to almost 30 million. We feel that next year we should be at somewhere around 45 million. So that's the way it's going to be. Now, as far as the demand is concerned, we feel, demand has been normal, not exceedingly buoyant, but we feel that in the coming quarters and the fiscal demand should. The new technology, new product models are being launched. Also, as far as the margin is concerned, smartphones is a lower margin business globally, and so is the case in India. And that is the reason, in our case, we are going to be deploying a lot of resources and capital in a backward integration play, in the components play, which is more margin accretive. And also, we are expecting the rollout the government PLI for the electronic components in non-semiconductor category. Yeah. So, once those projects are rolled out in the next 2 years, we should be able to restore margins to normal level. So that's the way it looks for the mobile business for us.
Absolutely, Mr. Lal. Hi, morning. Great to have you with us. And I think, right now, the stock's down about 9.5%. I guess the ask is always very high from a company like Dixon, right? Which is, stock is a great wealth creator. But now, as we say in the market, they'll always mange more. On the point of margins, sir, I think, and that's something that a lot of brokerage notes are also pointing out. Your mobile business is doing fantastically well. Volumes are fantastic. And now it's almost 90% of your revenue. Tell us how the mix will change, because some of the other segments like consumer electronics, that's where you get higher margins. While you backward integrate in mobiles and bring the margin profile up, what about the other segments? And in the near term, do you see yourself going above 4% on the margin in FY26?
So margin, we feel there is going to be in the range of around 4% in 26. Beyond 26, it should start inching up. Now, as far as other categories are concerned, we are focusing a lot on our appliances category. So we have set up a refrigerator plant. We are already acquired almost 8% share of the Indian market. We are further expanding the capacity, first from 1.2 million to 1.5 million, then from 1.5 million to 2.2 million. That's almost 8 to 9% EBITDA margin business. In other appliances, we are exploring addition to our product portfolio. We are expanding our IT product business, which would also be in a similar range of 4%, but is going to generate an operating leverage because of the scale. Then we are looking at expanding into the electronic component business. So we've already started work on our display module plant, which is much more margin accretive. So this is what we are pursuing. So as I shared with you, I feel that in 25-26, margin is going to be in a similar range of around 4%. However, once all these action points are fructified, then there would be an up of the margins.
And it'll go up to how much?
It should go up another 30-40 bips. It's around 4.5.
4.5 odd. All right. Hi, Mr. Lal. Good morning. I want to focus on your plan to foray into display fabrication business. The total capex I think you're talking about is roughly around $2.5 to $3 billion. So a few points out here. From Dixon, the company, how much will the outgo be? Because there will obviously be some support coming in from the government. So how much are you factoring in out of this $3 billion odd? Point number one, so funding. Point number two is what is the asset turnover? And point number three is the margins as well as ROCE, purely on this business that you're looking at.
So for Dixon to get into the display fab business is extremely important because if we are able to execute this project, it gives us a very, very significant moat. And it's required for Dixon, it's required for industry, it's required for the country. We are still awaiting the guidelines of ISM-2 of the Government of India. As per the earlier scheme, the central government was supporting all 50% of the capex on a pari passu basis, and the various state governments are offering almost 20%. So here we are talking about around 30%. This is a high margin business. This is in high double digits, the margins. So on a blended basis, it's going to have a significant impact on our margins. Let's say what the government guidelines are, and then we'll be able to determine the ROC. There's not highly working capital intensive. In Dixon, we have adequate cash flows. We generate significant EBITDAs. We don't have significant working capital.
Mr. Lal, we're just running a little short on time. So just to clear the air, out of this $3 billion back of the envelope calculations and going by the past precedent, it appears that from Dixon, you'll have to come up with only around 6 to around 700 million. Is that correct?
That also,
very roughly.
If we are able to bring in the equity from a joint venture partner,
then it'll be even less.
That's right.
So it'll be $7 million at peak, point number one. Point number two is you're saying on this particular investment, you'll do margins of double digits and ROCE will be more or less in line with what you're doing. It could be a little bit lower, I'm guessing, because of the kind of capital intensity. Is that correct?
The ROC is going to be slightly lower, but the payback period is going to be very, very fast. On the blended basis, the margins are going to go up significantly. Strategically, it's going to build a huge moat in the company.
And the asset turn will be close to around what? 1:1 or a little lower than that? From this $3 billion of capex, you can generate revenues of roughly around $2 billion. Would that be a fair estimate?
So let's say we are putting around $900 million from the partner side and our side, then it's going to be generating a revenue of almost 1:2, 1.8 to 1.
Got it. $2 billion, approximately 1.8 to $2 billion. Got that.
Okay, all right. Mr. Lal, thank you very much for joining us. Short on time, but not on questions. So we'll have you back on, sir, for a more detailed chat. But thank you very much for joining us with some of that perspective. We'll take a quick commercial break here. And we'll come back and put the spotlight on the FMCG space. Kunal Vora of BNP Paribas will be joining in. Expectations from the FMCG sector in just a bit from now.
Okay, big stock reactions playing out. You just heard the Dixon management there. Stock's still down about 10%. The other one, Zomato, which is still not recovered. Recovered slightly, to be fair. I mean, about 7% down, but it was down over 8% at one point in time. There you go. That's Zomato. So the result disappointments playing out on some of these stocks. Not so much results, maybe more to do with the commentary in case of Zomato. So let's get to that commentary and what the company is really saying. Here's a CNBC-TV18 exclusive. Blinkit CEO Albinder Dhinsa has said that the company will not enter the price war to drive growth. Speaking to us, he added that the company will grow at a faster pace in the near future and will continue to bet on new businesses like the ambulance service that they're now talking about, as well as fresh food delivery to boost its position. Take a look.
What's the visibility that you have on potential growth from here on, and do you believe that it's going to continue to be the kind of accelerated pace we've seen in the last 2 years, or do you believe that there is going to be, because of the base effect, etc., will also be a little bit of a slower pace of growth?
No, I think we will be able to maintain that pace of growth for the near future at least, and I think that's going to be powered by two things. One is obviously the geographic expansion as well, expansion within our existing cities, because we are still seeing that the cities are still under-penetrated. And there is also going to be expansion of the kind of products and the kind of use cases that customers use us for, right? And I think this is going to make sure that for the near future, we would be still, growing at a fairly fast clip. Most of our growth is more usually constrained by our ability to invest ahead of time in infrastructure, right? Yeah. So if you look at warehousing, the timeline for that investment is usually a year before we need it. When you look at stores, that timeline is about 6 months before we need it, right? So I think whenever we sort of look at growth, the challenge that it always gets cut off is not what we see where the potential market is going, but sort of where our supply chain capabilities will be. And I think with more competition, we expect the overall market size to also grow faster, because now there are more people out there talking about awareness. Yeah. Of course, that creates its own issues, but
so let's talk about the issues that it's creating. I mean, the obvious one that everybody is talking about is that there is going to be a discounting war, and what does that mean as far as profitability is concerned, including for the likes of you? What does it mean in terms of market share? How do you retain the kind of market share that you have? I mean, how are you looking at competition? What are you trying to do to create differentiation? What are you trying to do to create the moat around you so that you can take it on?
See, our point of view on this is not actually driven by competition, but more by what do we mean to the end customers, like what we were talking about, right? We are a way to sort of, for the customers to live a better life, which also means that they should feel smart about their financial decisions as well. So we can't be gouging them for pricing, like we said, right? We can't be like, hey, you pay 20% extra just because I'm coming to your house in 10 minutes. I think customers want us to be fair, right? But I don't think that discounting necessarily is something that we have indulged in or being involved in outside of what the brands are happy to do on their own, right? And I think we will maintain that way, because we don't want to lose our North Star, which is that service quality for the end customers, for solving for their actual use cases. And our ability to invest in better service quality is actually dependent on good economics, right? We can't be actually like burning a ton of money and then say that, hey, we will still continue investing in service. Then, why not do that first and everything else comes later? So I think we have sort of maintained that as a North Star, and we will continue to operate it that way.
Well, let's move on then. It's time for our special segment, Quarter Se Quarter Tak, where we get you expectations from each sector. Today, Mangalam joins us to help us out with what are the expectations from the FMCG sector. Mangalam, take it away.
Well, for the FMCG sector in the third quarter, let's first look at the demand environment, or rather the entire environment from either a demand input and even a cost and category perspective. From a demand standpoint, there's been no major change in conditions since the second quarter itself. Yes, there has been a gradual rural recovery, but urban demand is still sticky and struggling. Even as the festive season may support QOQ growth, there are a bunch of categories that may be impacted because of delayed winter. The kinds of skincare products or healthcare products that we've seen with the likes of Dabur, etc. as well. The third quarter also saw the return of inflation in some key raw materials like palm, PFAD, as well as leaf tea, key inputs for some of the companies like Hindustan Unilever and some of the soap companies as well. However, there was some support coming in from crude and VAM that is used by paint companies, but then again, they're seeing competition. Pidilite as well uses VAM. Speaking of paints itself, there is high competitive intensity in the sector along with beverages, where Campa has garnered 10% market share in some of the key states. The growth of quick commerce has far outpaced that of general and modern trade, which may impact some channel inventory for a few companies as well. There has been a good pickup in sales of apparel retail companies. That's what we've seen from the numbers that have come so far and from the results that have been reported so far in terms of updates. What we know is there have been weak updates coming in from Godrej Consumer, Dabur. There has been some margin compression for Marico, even though the revenues out there have grown in mid-teens. And at the same time, we are seeing, some of the others that have come by. The jewelry space, for instance, That did well in a seasonally strong quarter on account of higher gold prices and the festive season, with Titan reporting 26% growth and Kalyan Jewellers 41% growth in their India jewelry business itself. What are some of the key expectations then from companies like HUL, Tata Consumer, Britannia, Nestle, Trent? Middling sort of growth seen for HUL and Britannia, as well as Nestle, low single digits to about mid-single digits. Good growth seen for Tata Consumer on the revenue front, but then again, margins are likely to compress. And for Trent as well, it's likely to do extremely well, 38 to 40% in terms of revenue, 30-35% in terms of EBITDA. But the important part is that how much of that is in the price already. For the third quarter, jewelry sector will outperform, whereas staples, F&B and paints will underperform. There is likely to be some recovery in QSR after 8 muted quarters. And in terms of stocks, Pidilite may outperform because other paint companies are facing stiff competition. And finally, we're looking at Honasa, the accident of the second quarter. That'll be key to track in the third quarter itself. And apart from the numbers, the management commentary is something that we'll keep an eye out on, especially on expected pickup. And even we expect some impact coming in from government support schemes, the likes of Latki Bahin, etc., to aid consumption. All eyes will be on the budget. We're less than a fortnight away from the union budget. So announcements there, especially for sectors like tobacco, etc., will be important. From a valuation perspective, FMCG has not particularly been cheap, but the relative underperformance of FMCG stocks have made their multiples a lot more palatable than their historic valuations. Recovery in growth and earnings would be the key trigger for a lot of investors and analysts who are still on the sidelines when it comes to their stance on this space.
Okay, all right, got that. Mangalam, thank you very much for that. So that's the expectation from the consumer space, specifically from FMCG in this quarter. To talk about this and to take the conversation forward, we have with us Kunal Vora, Head of Equity Research at BNP Paribas. Kunal, great to have you on the show. So, I think the expectations are running high considering the market's kind of starved of ideas now in this, mixed environment. You tell us, can we look out for growth? Let's start with the staple companies and tell us, average volume growth, can it inch above, low single digits to, mid single digits? That's been the kind of range for the better part of this year so far.
Yeah, great to be on the show. Thanks for having me. So, like Mangalam covered it well. What we've seen is fairly stable demand trends. No real excitement which is coming in. We've had FMCG go through a rough patch in the last few quarters with low single-digit volume growth. There is some pickup in rural at the same time, nothing really exciting. If I look at the agri GVA, it was like 1% in first quarter, 2% in second quarter, about 3.5% expected in third quarter. So nothing really changing dramatically. While there is some pickup in rural, nothing big. On the urban side, the mass consumption clearly did slow down in the previous quarter. This quarter, the commentary which has come in from the companies so far does not really indicate that there is any meaningful improvement in demand trends. So you will expect most companies to deliver like say low to mid single digit volume growth. And at the same time, there is some pressure which is coming in the margins. So last few quarters, we did see while the revenue growth was muted, margins were well supported because of lower commodity prices. But that's changed since the previous quarter, last quarter. As Mangalam highlighted, like many of the FMCG key raw materials, especially the agro-driven, which are like wheat, sugar, milk, you got palm oil. All of these are seeing some inflation now. So the trends in terms of margins are reversing. So while we are expecting the revenue growth to be about 5-6% on aggregate, we expect EBITDA growth to be lower at about 3%. The sector is going through like a weak growth phase. There were expectations that second half will be better, but so far the management commentary does not really indicate that. And we believe that the modest growth will continue. Pricing is moved up, inching up a little bit. That should take the revenue growth up a bit compared to what we saw in the last two quarters. But on volume front, we don't really expect much of an improvement.
Let me reiterate that number. That was a really sobering number. Nothing great. You said, if I heard you right, you said about 4 to 5%. And was it top line growth or volume growth? And then you said EBITDA growth is going to be even lower at about 3%. Can you just repeat the numbers?
Yeah. So about 5% revenue growth and 3% EBITDA growth for the companies which we cover on aggregate. So yeah, nothing really exciting there.
Okay, so let's try and pick a silver lining here in this rather sort of somber cloud. Relatively speaking, which are the companies which you think can unleash their operational efficiency and kind of tide against this rise in raw material inflation, maybe have some price elasticity at all? I don't know if anyone's thinking of price hikes, but relatively speaking, who do you think can, manage this the best?
Unfortunately, there is no silver lining, at least which I see this quarter. So the EBITDA growth expectation which I have is anywhere between -5 to +5. So even the best of the lot will be more about like mid-single digit EBITDA growth. So while there is some pickup in revenue, like say if I look at revenue growth, there will be some companies like Marico which have had like a commodity price increase, will like deliver like say low teens kind of revenue growth. But even there, the margin pressure will be fairly elevated. So when it comes to the EBITDA line, we don't expect any company getting to double-digit EBITDA improvement.
Okay, slightly longer-term question, not just Q3. This change in the channel mix, right, with quick commerce becoming such a huge sort of part and parcel of life now. What impact do you think this is having, if at all? I mean, Dabur, we all know, we all remember that they called it out. But are other companies going through this? And does it cause any disruption in your overall projections as this channel grows in scale and size?
Yeah, in fact, this is one of the themes of our 25 outlook, that disruption is visible across consumer businesses. These businesses get the kind of multiples which they get because they are expected to report moderate growth, which can be low double digit and with minimal disruption risk. But as I see right now, like you highlighted quick commerce, but like there is disruption visible in various consumer businesses. So if I look at like consumer staples, both branding and distribution. On branding, consumer companies had a complete control through television. Today, through digital, branding can be done by anybody. Yeah. On distribution front, what we are seeing is earlier they had a very strong hold on distribution, which was extremely fragmented. Today, distribution again is going through a consolidation. You have modern trade, e-commerce, quick commerce, and in top cities, these are almost 50%. As they become larger and larger, they will be more and more demanding. And we are at a stage where the growth has been slow. If I look at last decade, revenue growth has been 7-8%. But the consumer companies managed to report decent earning growth through margin expansion. But as we are right now, where we are right now, margins are at a fairly elevated level. There is competition coming in from the unorganized at the bottom end, and at the top end, there are niche brands which are coming and competing. So the setup is not really great. So you have margins which might be very close to the peak, and the growth which remains fairly muted, and with additional risk coming in from the various disruptions.
Absolutely, Kunal. That's a point very well made and very well taken as well, that it's not just the change in the channel mix, but yes, branding and marketing. I mean, nowadays, you don't buy whatever the ad tells you. Consumers are buying whatever is most convincing on their Instagram algorithms, right, in the feed. So absolutely, digital has changed the rules of the game. Thank you very much. Good conversation. We look forward to more as we go forward. But now, of course, we do have to take a quick break. So we just a quick look at the market, which has sold off very aggressively. I mean, now it's not gains have come off. We're down actually on the day now. So 80 points lower on the Nifty. So this is a complete reversal, actually, which means we're down almost 160, 190 points from the day's high, which was basically right after open. So 23,264. Let's just quickly look at the Nifty Bank as well, where I think there is a significant reversal which is underway as we speak. I think you got about 300-point cut, about 0.6% lower. 49,040 is where we stand at. So that's markets for you. We'll take a break here. We are back and we talk about oil prices and other commodities. Manisha with us with what's top of mind for commodities. Stay tuned. Welcome back. So yes, there is a cool-off underway in the Indian market, not so much across Asia. In fact, even US futures are in the green now, but our market is dealing with its own situation. That's equities. Let's find out what's happening in the world of commodities. We have Manisha joining in. Manisha, I'm sure you have your hands full today with so much to track. So what have you chosen right now?
Oh, well, I'm looking at sugar right now because the non-agriculture commodities are way too volatile right now. But so is the case with sugar as well, where we have seen very volatile price moves. So when you look at the raw sugar prices in the international markets, we are trading at a 5-month lows right now. This is after the Indian government has allowed 1 million ton of export for the season 2024-25. Well, if you look at the numbers right right now in sense of exports. We have allowed 1 million ton right now. Last year was nil. It was prohibited to export by the sugar industry. 2022-23, the Indian exports were at 6.1 million ton. And then back then in 2021-22, it was a record 11.1 million ton. So as you can see, it has been a very choppy last few years when it comes to Indian sugar exports there. And that is exactly what we have seen in sense of prices. So last year, the raw sugar prices fell by 8%, and in 2025, already down by 5.5%. Well, our supplies outlook is quite favorable. India exporting to the international markets is one part of it, but the Brazil crop, Thailand, which is the third largest sugar producer, also is looking at a bigger production this time around. Well, actually, USDA also says that the US sugar production this time around is also expected at a record 9.4 million tons. So you have enough and more sugar in the global markets right now. Thailand, as I said, is looking at an estimated 18% jump in its sugar production as compared to last year. So enough and more sugar in the international markets, and that is bringing the prices down. So while the export as one thing in sense of policy has already been done, what the Indian markets are now looking at is the minimum selling price for sugar, which hasn't been changed since 2019. And the other thing is the ethanol made from sugarcane juice in India, that pricing also has not changed since 2022-23. These are the couple of things that the markets feel are yet to come by. When you look at the Indian markets itself, when 10 lakh tons of sugar that has been allowed, within that, the notification says that the government has debarred mills that violated the domestic sales quota from exporting. So those, they cannot export. There actually is a full list of 4 pages on which mills can export, which mills are debarred, etc. The other thing is that when you look at the overall calculation, the 3 major states, and this is how the allocation for exports have been put out, Maharashtra clearly stands to gain a lot. Maharashtra sugar mills, that is, at 3.75 lakh tons, and then you have UP and Karnataka getting it at 1.75. The expectation is that much of this sugar perhaps could also move into Maharashtra, and Maharashtra, as in that sense, will stand to gain. Now, mills with an export quota are given at 3.2% of their average production in last 3 years. The new sugar mills also are eligible to export if their estimated production stands strong. The export is permitted until September 2025. And more interestingly, when you look at the numbers on what the sugar mills stand to gain is interesting. And this clearly comes in from various industry guys that I have spoken to. So if in domestic markets you are selling sugar at 3,500 rupees per quintal, if you look at exports, all the calculations done with 3,900 is the realization there. So clearly, sugar mills here stand to gain.
All right, Manisha, thank you very much for that. So that's basically the picture on sugar and commodities overall. 80 points lower on the Nifty is what we have, 23,261. We'll take a quick commercial break here. We'll come back with our special segment. It's the economy. My colleague Latha in conversation with Chetan Iyer of Morgan Stanley on the possible impact of Trump administration and its policies on Asia and India specifically. Stay tuned.